down 21.6%. This is one of the most boring stocks on the market, and it just moved that much in one session. Only 4 moves bigger than 5% in an entire year. What's up, guys? Coach B here. Welcome to the breakdown. Today it's Albertsons, ticker ACI. 5 days ago on the channel, I broke down a growth name that beat on every line and still fell 14%. This is the opposite kind of stock, and that's the point. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell anything here. Do your own research. Here's the baseline you need first. Albertsons is about as low drama as stocks get. Same week this happened, Stock Story pointed out it had only had 4 moves bigger than 5% in the entire last year. And measured after this drop, it sits 33.9% down year to date and 45% below its 52-week high. This is not a stock that's priced for excitement. And this wasn't just Albertsons having a bad day in a vacuum. Same day, July 23rd, on a weak consumer read from Bain and Nielsen IQ, the whole grocery group was soft. Kroger fell 3.3%, Dollar Tree fell 3.4%, Grocery Outlet fell 4.9%, Albertsons fell 21.6%. That's about 5.6 times the group average, and that gap is the company, not the sector. Before any of this, Albertsons was just a quiet grocery stock. It opened at $14 on June 24th, drifted between about $13.50 and $15 for most of the next month, touched a high close of $15.11 on July 17th, and closed the day before earnings, July 22nd, at $14.60, then July 23rd. In the pre-market, this thing was already down about 14%. It opened at $12.50, a straight gap down, and it never traded above that opening print the entire day. It kept sliding into the afternoon all the way down to a low of $11.02, about 24.5% off the prior close before clawing back some into the close. Final print, $11.44, down 21.6% on about 47 million shares, about 7 times its 20-day average volume. So what actually happened in the print? Net sales came in at $24.9 billion, up 0.2%, a slight beat, and digital sales grew 13%. But adjusted earnings per share was 42 cents against a 54-cent estimate, a 22% miss, down from 55 cents a year ago. GAAP earnings per share fell to 17 cents from 41. For the quarter, identical sales were down 0.8%, and gross margin slipped 50 basis points to 26.6%. Genuinely mixed. Here's what actually re-rated the stock. It's not a multiple story, it's a base story. The full year guide got cut. Identical sales guidance went from 0 to plus 1%, down to negative 1.5 to negative 0.5. Adjusted earnings per share guidance got cut from 222 to 232, down to 175 to 185, a 20.7% cut at the midpoint. Adjusted EBITDA guidance dropped from 3.85 to 3.925 billion, down to 3.55 to 3.625 billion. Here's CEO Susan Morris. In the first quarter, our digital and pharmacy businesses continued to deliver strong growth, while core grocery faced increasing pressure from softer industry unit trends and a more cautious consumer. Translation: shoppers, especially lower income households, are trading down to Walmart, to Aldi, to private label, and away from a traditional grocery chain like Albertsons. That's not a one-quarter problem. That's a full-year guide saying it keeps happening. And the street had to reset in a hurry. On the day of the print, Wells Fargo cut the stock to equal weight with an $11 target. That's below where the stock actually closed at $11.44, and a long way from the $14.60 it closed at the day before. A few things piled on the same day. The company's president and CFO announced her retirement that same morning. In a separate release, she's staying on as an advisor until a successor is named through February 27, 2027. And Albertsons rolled out a restructuring called ACI Edge, consolidating 11 divisions into 4 regions, targeting $200 million in annual savings by fiscal 2027. You can read that as getting ahead of the problem or as a sign of how much trouble they're actually in. Both readings are on the table. And heading into the print, short sellers were already leaning bearish on this name. They got proven right. One quick clarifier. This has nothing to do with the ongoing Kroger-Albertsons merger litigation. That's a separate, unrelated case. This was about the print and the guide, full stop. So here's the actual lesson, and it's the mirror of the intuitive surgical video from 5 days ago. ISRG fell 14% on a small guidance trim because it trades at a rich multiple, a premium that's really a bet on growth staying high. Albertsons doesn't carry that premium. It's a defensive grocery stock, one of the least volatile names on the board. What took it down 21.6% wasn't a multiple getting cut. It was the earnings base itself getting cut. Full year EPS guidance down about a fifth. Defensive describes the business, not the stock. If the number underneath moves, the stock still moves with it. One more thing to sit with. That new guide is still a range, 175 to 185. A cut guide isn't the same as a safe guide. The low end of that range is 175. And if industry trends keep softening, even this lowered bar isn't guaranteed. There's always risk in everything. So how would you think about this by time frame? Day trading it, you're trading pure volatility off that 1102 low. Swinging it, 1250 and 1102 are the levels the market drew on July 23rd, the gap down open and the intraday low. And if you're an investor, the real question isn't this quarter's print, it's whether this guidance cut is the bottom or the start of more cuts. So that's Albertsons, one of the most boring stocks in the market until a full year earnings base got cut by about a fifth in a single quarter. Same reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. Subscribe, and I'll break down the next name on the board and drop your questions in the comments. Good luck in the markets, no matter what stock you're into.